On April 28, 2026, U.S. investors treated OpenAI growth concerns as a trigger for profit-taking in overextended AI hardware and infrastructure stocks ahead of mega-cap earnings. The S&P 500 fell 0.5% to 7,138.80. The NASDAQ fell 0.9% to 24,663.80, and the Dow slipped 0.1% to 49,141.93. The rally did not break, but the tone changed. The pressure started where the market had been most confident: AI infrastructure. Broadcom, NVIDIA, and Micron all weighed on the tape after reports that OpenAI leaders were concerned about whether user and revenue growth could support very large data center spending plans. The important word is concerns. This is not proof that AI demand vanished. It is a reminder that the market now wants visible payback.
That timing matters because the biggest AI spenders report next. Alphabet, Amazon, Meta, and Microsoft are all scheduled to report on Wednesday, April 29th. Those reports will not just be about last quarter's earnings. Investors will be listening for cloud demand, AI CapEx plans, margins, and whether management teams can defend another year of heavy infrastructure build-out. The market's problem is not that AI spending is small. It is that AI spending is enormous, and the return profile is still being argued in real time. If spending keeps rising while revenue targets look harder to hit, the stocks that benefited most from the build-out become easier to sell first. That is why a user growth story at OpenAI can spread into chips, cloud, power, and fiber. All of them depend on the same data center spending cycle. Corning shows both sides of that trade. First quarter core sales rose 18% to $4.35 billion. Core EPS rose 30% to 0.70 cents, and optical communication sales rose 36%. That supports the AI infrastructure demand story. But second quarter core EPS guidance of 0.73 to 0.77 cents included extra cost from a solar wafer facility shutdown. Strong demand is helpful, but investors are still checking the cost side. The compute discussion is also broadening beyond GPUs. One market argument is that agentic AI could lift demand for CPU-heavy workloads and custom chips, including Amazon's Graviton ecosystem. In plain English, if AI agents need more general-purpose compute, cloud providers with their own chips may have more leverage. The cleaner test is whether cloud providers can show demand that justifies the next wave of infrastructure spending. Robinhood adds a separate read on risk appetite. The company reported first quarter revenue of $1.07 billion and diluted EPS of 38 cents after the close. That still shows year-over-year growth, but the stock's reaction matters because Robinhood is tied to active retail trading, crypto, options, and market confidence. If speculative activity cools, the impact can show up quickly in brokerage-linked names. Domino's is the consumer-side contrast. The company reported first quarter revenue of $1.15 billion and diluted EPS of $4.13, with U.S. same-store sales up 0.9% and international same-store sales down 0.4%. The business is still growing in several ways, but the stock reaction shows how little patience investors have for slower growth when margins, value deals, and competition are all in focus. Energy risk also moved back onto the screen. The United Arab Emirates said it will leave OPEC effective May 1, and oil prices rose more than 2.5%, while the Strait of Hormuz remained blocked. In the near term, Hormuz keeps the supply picture messy. Longer term, the UAE exit weakens the old OPEC coordination story and could change how traders think about spare capacity and price discipline. Rates are still part of the setup. The Bank of Japan is dealing with volatility in the long end of the JGB market, and any stress there can matter for global duration, treasury yields, the dollar, and gold. This is not today's main U.S. stock story. It is the background condition. Record high equity markets are more fragile when oil, rates, and AI valuations are all being questioned at once. Income investors are watching coverage too. Main Street Capital's preliminary first quarter estimate put distributable net investment income at 98 cents to $1.02 per share. That does not mean the regular monthly dividend is immediately at risk. It does mean special distributions need closer watching when earnings power softens. Watch first whether the Wednesday megacap reports confirm AI demand without damaging margin confidence. Watch second whether AI profit-taking stays contained to the most crowded infrastructure names. Watch third whether oil and rates stay in the background or start pulling money away from equities. If the first two break the wrong way, April 28th starts to look less like a pause and more like an early warning. The market is still near records, but the burden of proof moved higher. AI winners now need to show that spending converts into revenue, cloud demand, and margins. Consumer and income names are being judged on execution, not just brand quality or yield. If mega-cap earnings give investors real evidence, the rally can stabilize. If they do not, concentration becomes the market's weak spot again.